I thank you. Good morning, ladies and gentlemen. I'd like to call this hearing to order and acknowledge that we're in Treaty 1 territory, the home and the traditional lands of the Ojibwe, the Cree, Dakota people, and the national homeland of the River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. My name is Ron Merritt. I'll be your chairperson this morning. Introducing the panel members, we have via the Zoom, we have Valerie Warhan and Mr. Kent Saline. Our recording secretary is Nicole Carnegie, and representing the city of Winnipeg from the assessment department is Matthew Barocas. To the Zoom participants of the hearing, please note that you will be placed in the waiting room until your property is called upon. When it is your turn, you will be admitted to the meeting. Kindly follow along the City of Winnipeg's Board of Revision YouTube channel for the hearing process. Once the host admits you to the hearing, please close or mute your YouTube player. You will then be permitted to speak in respect to your property. Once hearing has been concluded, you may leave the hearing. This morning, we'll be hearing an application for revision of the assessment roll in accordance with the Municipal Assessment Act, the matter for which revision is requested and described in each application, and we will limit discussions to those matters. The statements that are made at this hearing are sworn testimony, and anybody speaking in these matters must be sworn in. Please be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The board is appointed annually by City Council and is independent of it, along with the City Administration. We make our decisions based on the evidence provided at this hearing and issue a written order that will be mailed to all parties as soon as possible. Please note that the board's decision in respect to application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to application from exemptions from taxation. Should you wish to appeal, information on how to do so will be included in the board's order. In respect to the hearing this morning, I will confirm the points of appeal with your properties to be addressed with each applicant following the swearing in. It will be then the assessor's testimony followed by questions that the applicant may have. Then it'll be the applicant's testimony followed by questions. Each side will have the opportunity to summarize if they wish. Once all evidence about the application is brought forward, the applicant may leave. The process will repeat for each item on the docket this morning. The session will close after all applications have been heard, and the board will deliberate in private and make its decisions. You will receive the board's decision by registered mail as soon as possible. As information, all public hearings are live stream recorded and will be part of the public record. This morning, we'll be hearing items 1 to 6 on our docket, and I ask Ms. Carnegie to affirm the assessor and to swear in the applicant's testimony. Thank you.
Thank you, Mr. Chair. Mr. Assessor, please state your full name.
Stephen Barocas.
You affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Mr. Applicant, please state your full name.
My name is Jarrett Story.
You affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you.
Madam Secretary, we have 2 properties here, 748 Banning Street and 757 Banning. I understand there is no applicant present?
No, Mr. Chair, there is no applicant present.
All right. So accordingly, we will move these to the end of the docket and deal with them at that time.
Okay.
All right. So we will first go to the first item that we have is 105 Sage Creek Boulevard. Mr. Barocas, there's a series of assessments with, and the first one being a reference date of April the 1st, 2018. So we'll deal with that one first, if you don't mind, Mr. Barocas. So whenever you're ready, you can take us through this property. Yes.
Is,
Mr. Marcus?
yeah, is that, okay, so I think Academy is the one that has a few reference years. I believe Sage Creek is only 2023,
Okay.
unless I'm mistaken.
Sorry. You're absolutely correct. All right, the
Okay.
floor is yours, sir.
Okay, thank you. So let me pull this up here.
And Mr. Chair, just so you're aware, there's 2 points of revision on this one as well, the classification and the amount of the assessed value.
Oh, and
Yes.
just preliminarily, Mr. Chair, we are not pursuing the class code. We're withdrawing that. So we'll simply be speaking to value today. So that should make things go a little smoother. But
All right.
we're not.
So I think, Mr. Story, then you have to complete some withdrawal form so our secretary can inform you in that respect.
Sure. That sounds
Okay.
good.
So we're only dealing with quantum. So Mr. Brockus, whenever you're ready, you can take us through this. And there's also, I see that there's a split in regards to class code. So the floor is yours, sir.
Okay, thank you very much. All right, file number 23-425, roll number 06093236500105 Sage Creek Boulevard. 2023 roll year, April 1/21 reference day. We got a split class code, 37,461 total. You can see we got 3.6 for the 60 class code and 33,000,008 for the 2020 with some change on the side. That's how we get to the 37,461. It's a mixed use apartment, so it's got some commercial area on the main, on one of the buildings there, and predominantly it's an apartment. You can see from the valuation, recently built. From the property description, 152 suites. We got 173 outdoor and 73 indoor. Parking, page 2, they're kind of beyond the reference of where we would be able to get a pre-reference date mailer, so we don't have any mailers from them appearing in our brief. Subject sale history, that has no bearing in regards to the improved land. Taking us to page 3 on the property, we got our income value summary. See, out of the 152 suites, we got 103 one bedroom, 36 two bedroom, and 13 three bedroom, making up the complement. Average monthly rent per unit, $1,411 and 81 cents for the residential component. And then you also have the office breakdown as well here that follow. So just in regards to the residential component, I was glancing ahead at the applicant's brief. We are within $2,000 in terms of net operating income. Applicant actually a little bit higher, unless anything's changed. It appears that it is preliminary. It is from the residential side of the coin. It's a cap rate issue. So I'm not gonna sit on the rent comparables for very long in regards to trying to speed this process along for the apartment. So expense ratios, cap rates are modeled and for the office, the income is modeled. You can see the parameters here. So we got 33,837 for apartment, and you can see the office valuation as well. Okay, so we've got our subject property market income right here for you can see the commercial rents that the model has assigned. They range in the $24 to $27 range, or rather $28.50. So they're clustered around that amount as assigned by the model. Square footages range around 1,200 to 1,500 square feet per commercial unit. Rent comparables follow for the apartment side on page 5. Again, I'm not going to go over these because we have agreement on net operating income. Comparable leases are here on the following page. So I was trying to get comparable leases, obviously, in the Sage Creek general area first and foremost. So 50 Sage Creek is actually just across the street. It's in an entirely commercial area, but it literally is just across the street, a commercial property. And you can see that the lease areas are highly similar to those on our subject property today, and they're renting in the $28 range. So I thought that was pretty strong evidence to support our modeled rents. I got $31 as well, and $30. Obviously, 40 Lakewood and 119 Vermilion aren't in the immediate area. They're more towards I believe Island Lakes, like Southdale type area, further west on Bishop Grandin. But it does show the general range of kind of like suburban commercial in this respect. Just so you can get an idea where the rents assigned by the model are coming from. So I didn't see anything out of line in terms of the commercial rents in that respect. So I didn't make a change. Page 7. Page 7, you've seen this table a bunch of times. This is just an example of actual sales that took place during the reference period. You heard me mention this before. Literally just took some sales, stabilized our net operating income over the known sale price, generated a cap rate. So we got 2390 McPhillips at 4.79. It's actually 4.70. I have submitted a rebuttal which shows the calculation, but I know from the familiar faces today that we've all seen and gone through that, and I will spare us that entire presentation unless it's necessary. So 2390 McPhillips would be the most similar in regards to the year built, the overall size. It would be the most similar property a potential purchaser would use. To compare, to try and come up with what sort of cap rate ought this property be assigned upon negotiation with the vendor in a hypothetical sales transaction. So the model's sitting here, 4.7. McPhillips is sitting around 4.7 as well. In my opinion, like 2390 McPhillips it's surrounded by like a Walmart, car dealerships, commercial activity. In my opinion, the Sage Creek location is more desirable. While there is retail around it, as mentioned earlier in my presentation, I think that overall the Sage Creek area is newer and more desirable. So I think at 4.7 we're right on the money with the cap rate for the subject property. I didn't really consider the other cap rates on page 7. Page 8, this shows our general cap rates here. Our cap rate table, you've seen this 100 times on page 8, so I won't talk about that. Municipal excerpts are on page 9. And this is just the old, this property was heard before the commercial was put on, just in terms of the commercial aspect for 2023 already, and the residential component was confirmed. And okay, I don't see any common names here. And here's just some other, I know orders from the area. I don't know if you can consider them just on Sage Creek at 4.75 for the residential component. Decisions recently rendered. Yeah. Then some pictures beginning on page 15. Disregard the top page 15, that's the order pertaining to a different property. I don't know why this picture got stuck on that closely. This is just a picture of the outside of the property, so you can see it's newer, and in line with what we're seeing for the newer built properties. You can see on page 16, the commercial stuff on the bottom of one of the buildings there, the 115 building. So it looks like it's got good street front exposure to the property. So people going by, people who are looking to, there's a kind of like a retail shopping little strip mall area on the other side of the street. They would see these units as well. So I think it's a good location. Some more pictures of the inside follow on page 17 through, pardon me, 27. So there's some commentary, again, in line with what we're saying for newer builds. It looks good. It's good to me. And then on page 28, I did, again, disregard the table, the green table. But you can see that the adjacent commercial I was referring to across the street, 3 and 4 on 55 Sage Creek, which is across Burning Glass. You can see how it's the same area, same spot. So they're 31, we're like 28, 25. I think the rent's supported. And then on the final page of my brief, 29, there is just a breakdown in regards to what amenities. I won't bore you by reading them off. That's my evidence. Thank you.
Thank you, Mr. Brocus. I just got one question for you. Can you give us the 60 and the 20 values? So,
oh yeah, for sure. So the 60 value is 3,623,000.
Yeah.
And the 20 is 33,838,000. The 60 is 3,623,000.
Okay. So in total, 37,461,000, correct?
Yes, sir. Yes, thank you.
Right. I thank you. Mr. Story, questions of Mr. Brocus?
I do, Mr. Chair. Thank you. I have a number of questions here. Mr. Brocus, the first question I had, and Mr. Chair, I'm going to page 10. This is a decision on this property that was included here. Now, I was,
okay. I'm going to interrupt you because we've been told that these decisions are not to be brought forward or given any weight because they're lacking all the material that goes along with the decision. So these type of hearing results will not be given a lot of weight because, like I say, the panel is missing all the evidence that was brought forward in that meeting. So unfortunately, I know that's your presentation, but we will not be giving it a lot of weight. So you can continue, Mr. Story.
Okay. Well, all right. They're in evidence, so I would. So the board is not prejudiced. I would like to give context, but okay, that's fine. If we're not able to, that's okay. But of course, we object to, as you've said, Mr. Chair, we object on the same basis, and we certainly object to including the decisions of another agency in the evidence. Okay, Mr. Barocas.
Well, Mr. Story, you can sort of see the panels. Like we do not have evidence in front of us in regards to what the other panel. So it's really not fair to the panel members to
absolutely. No, I agree. I don't think it should be included in the assessor's evidence either.
Okay,
but it's in here, so I won't speak to it, but we object to it for the record, Mr. Chair. Okay, Mr. Barocas, in terms of this property, can we agree that indeed it is a complex? So it's 6 buildings on 2 separate rolls, but they're directly adjacent.
I mean, on this property, it says we've got 4 buildings on the record. Are you talking about the overall operation? Like if there's like an adjacent property that's.
Okay, so I guess I'm guessing you haven't visited this property. Is that fair?
I don't
There's
believe I have.
okay, so there are 6. I mean, you can look at an overhead photo.
Yeah.
There are 6 residential buildings, and then there's a clubhouse, and they're on 2
Oh, yeah.
rolls,
Yeah,
right?
I did. I did actually put this one on. I didn't get the chance to visit it.
Okay.
But I did put this on now that
And
I'm
you
looking
handled the
through it.
appeal of 145, which is the sister building, correct?
Probably. I've handled
Yeah,
a lot of
okay.
appeals.
Yeah, okay. Now there are 3 buildings on this roll and 4 buildings on the other, but they do operate as a single economic unit. Now, if the model had all buildings on the same roll, would it treat the assessment differently? Would it assign a different cap rate, for example?
I'm not sure.
Okay. Now, in terms of, so later on in your brief here, you've mentioned, I think, that the average suite size is 1,367 square feet, but that's in error, is it not?
That's not what that says.
Well, if you go to page 5, it says your gross floor area per unit is 1,367, and that's simply mathematically a division of the gross floor area 207,769 by the number of suites 152, is it not?
Yeah, but that's not average suite size.
Yeah, well, okay, right. So you're saying it's the gross floor area per unit. So you're including the commercial space.
Yeah. I believe you just froze out there for a second. If you said something in the past 5 seconds, I didn't hear it.
Oh, okay. So I'm asking on page 5, where you're suggesting that the subject's gross floor areas per unit are 1,367. That is indeed much higher than actual, and the way you've calculated that is by simply taking the gross floor area of the building, which includes the commercial space, and dividing it by 152, correct?
Well, that's what it is, the gross floor area per unit. So the number is not wrong. It's the gross floor area of the entire building.
Right. Okay. So, but it's erroneous by including that figure. You're suggesting on page 5 that the suites are much larger than they are you not?
No.
Okay. So on page where you have the listing, okay, on that table, I think it's your page 28 or 29, 28, it shows that those suites range from 484 square feet to 1,187 square feet.
That's right.
Right. So when you're suggesting that the floor area per unit is over 1,300, do you not think that's misleading when you indeed have 484 square feet suites in this building?
No, because it says gross floor area and then gross floor area per unit. It doesn't say unit size.
Per unit, per residential unit, right?
It says gross, you just take the residential units and you divide it by the gross floor area, meaning it would include all other areas. So I think you're maybe missing the connection.
No, I think you're missing the connection, because I think you're including the commercial rental units and you're packaging them into the residential units. Isn't that exactly what's happening here? When you take the gross floor area of 207,769 and you divide it by 152, you come to 1,367. So you're now including all of the main floor commercial on an average or a per unit basis for the residential, are you not?
Well, that's what gross floor area means.
Not per unit.
Gentlemen,
Okay.
Aren't your NOIs fairly close?
Yes, sir, but I'd like to get to the cap rate. Yeah, no, we're not concerned with the NOI, sir. We're considered with the cap rate. Okay, Mr. Barocas, in terms of this, and we've mentioned that it's a complex, can we agree on page 3, this is just mathematics, that the contribution of 1-bedroom units to to the 152 suites is 67.76%.
Let me get out my calculator here. How much did you say that was again?
It's 67.76%, 103 into 152.
Yeah, that's what I'm getting.
Okay, and for these new, and then just so we're to finish this off, the 2 bedrooms contribute 23.68%, correct?
Yes.
Okay, and the 3 bedrooms 8.55%, correct?
Yes.
Okay, so in terms of the suite mix, Mr. Chair, this does affect the cap rate from our perspective. Does this suite mix, if you are to look at it on a standalone basis, does this not seem to be a very, very high amount of 1-bedroom units on this roll for a brand new building such as this?
I don't think so.
You don't think 67.76% 1-bedroom units would be very, very high for a brand new suburban tower such as this, or I suppose it's low rise, but
I mean, I don't have any like report in my brief.
oh well, okay, so
where I can reference that.
Well, I guess we can on page 5 actually. So if we look at Ancaster Gate, would you agree with me that the percentage of 2-bedroom units is actually 76.81%?
Hang on, let me get my calculator out here. We still agree on NOI?
Yeah, we're just talking about the cap rate.
Okay. What was that number again?
53 of 69 is 76.81%.
Okay.
So that's 3 times more 2-bedroom units than our subject, correct?
On a percentage basis?
Precisely. So our property only has 23.68% 2-bedroom units. Ancaster has 76.8, Bridge Lake has 64.42, Ward has 98%, and Bison has 50%. So all of these properties that you're saying are contemporary for the rental comps, when we look at them, you can see that they are indeed built with a much higher degree of 2-bedroom units. Do you agree with me, mathematically?
Well, I suppose the person who constructed this subject property had something else in mind.
Well, no, the subject property, this is where I'm going next, most of the 2-bedroom units are at 145, and it operates as a single economic unit. Okay, now in terms of the cap rate, I'm sorry, did you say that was modeled or that was applied by a person? That's modeled, okay.
Yeah.
And you said that 2390 was your best comp, but and Mr. Chair, I appreciate we've gone through this a number of times, but Mr. Barocas, you're undoubtedly aware at this point that the rents were raised upon acquisition, so that that cap rate that you're suggesting here is based on the previous years leading up to the sale, but do not account for the motivation of the purchaser to purchase the topside economic potential of rents that were indeed below CMHC averages at the time of acquisition. Is that a fair comment?
I used all the information that occurred prior to the sale. I didn't use any post-sale information. I don't think they busted out the CMHC tables. I think the vendor and purchaser probably used the rents in place at that time.
Okay. So we typically, can we agree, we don't typically use sales that were as per the order of the municipal board. We typically don't use sales where there was an intention to renovate, and the reason for that is it's an atypical motivation where you're not buying the rent in place, but rather you're buying the upside or the topside economic potential, so the ability to raise the rents. Is that a fair comment? Is that your understanding?
I think there's more nuance than that. I've seen municipal board orders where it says The intention to renovate does not necessarily not include the sale for analysis. Renovations have to be substantial in regards to major structural repairs, redemising of interior walls in order to disqualify the sale. This is within the same municipal board order that Altus has submitted to try and put forth this contention. So if the renovation is large enough, yes.
Right.
But if it's not, then it's fine.
And the renovation that we're talking about typically corresponds with an increase with the ability to raise the rents, correct?
It means that they wouldn't necessarily, it means they would, the idea is that they would totally discount the income and expenses that are in place. Is my understanding.
Okay, and I'm just looking at the broker's reports that you've submitted here on page 8. We can agree this property is not a high rise, correct?
I don't think it is.
No, it's 4 stories, right? So a high rise is typically 6 or more. Is that not your understanding?
Yeah, looking at it, I wouldn't call it a high rise.
Right. Okay. And then so all of the brokers here are suggesting no less than 5%. Is that correct? And 5 or 5.25 based on CBRE's low rise A, correct?
Yeah, but I mean, I'm not sure how they came up with their cap rate ranges. I know one of the companies here that's listed, I've had them under appeal, and in their cap rate report, it actually says they take the net operating income following the date, the latest year after the date of the sale, not leading up to the sale, which is inappropriate. So it makes, I don't really put weight on what the brokers have to say.
But it is in your evidence, correct?
Sure.
Yeah. Okay. Okay. And then we won't speak to these decisions clearly, but I guess I am curious why you didn't put the decision for 145 Sage Creek in if it's the sister property and if they operate as a single economic unit. Why would you not put that?
Oh, I mean, I just threw these in because these ones just occurred at 130 Sage Creek. Just happened. I've seen Altus throw decisions, and I understand that they don't get reviewed, but at least if they're going to get tossed out, at least the panel tosses both sets out. I'm not sure. I don't know. I didn't really. This is like a throwaway thing. I didn't think that the panel would even consider it.
Okay, but the sister property is a high rise and it was applied a 5% cap rate, correct?
I don't know. It's not in my evidence.
Okay. Mr. Chair, I've provided it for rebuttal, but I understand we're not going to look at this, so I'll carry on. Mr. Barocas, in terms of this property, sorry, you said did you say you haven't visited this property?
I don't think I visited. I know it was during the pandemic when I was putting this on. I was talking to Marcello, but I don't think I've been there.
Okay, and these are just marketing photos, correct? And that's fine. These are the same marketing photos we have, but the question is, I suppose, are you aware? And we've talked about 145, the high rise with all the amenities in it. Are you aware that the clubhouse that has the tenant amenities as well as the pool, those are not on the roll under appeal today? Those are on the 145. Okay.
Yeah.
So effectively, in your mind, does the fact that this property has this very high degree of the 1-bedroom units in this complex, and the fact that it doesn't really have any amenities, those are all part and parcel of the adjacent roll, does that not lead you to believe that cap rate that's been applied by the model is too low, or it hasn't taken into consideration those facts?
I don't know how that could be connected to like a risk thing. I don't know how that leap is made, to be honest.
Okay. Well, does a 1-bedroom typically rent for less per month than a 2-bedroom?
And that's reflected in the gross potential rent. It wouldn't be double dipped into the cap rate consideration.
Okay. Now let's go into the commercial space very quickly. You mentioned the space across the street, but that's more of a traditional shopping center. It has a large parking lot. I was there yesterday. That's anchored by some national covenants. Just to be very clear, ours are 4 units on the main. Those are not national covenants, rather those are locals, we'll say. Is that fair? Is that your understanding?
Yeah, I don't think there's like a Home Depot.
Well, not just a Home Depot, but I mean, there's a coffee shop, but it's a local coffee shop, and there's an ice cream place, and it's a local ice cream place, that sort of thing. Whereas across the street, you've got Mary Brown's, you've got Domino's, you have a Liquor Mart, you have a Pet Value, you have a Dollarama. So you have national covenants versus local operators. Is that fair?
Yeah, and that's
Okay.
bringing people right by that local ice cream shop, and they can stop for an ice cream after they get their beer.
Okay.
I think it's a bonus, actually, not a negative.
Okay. But you haven't visited, so you haven't seen the setup, the actual retail on 55 Sage Creek is in sort of a U-shaped and it's inward facing. And this is on that outer periphery, right? And these are typically services that cater, I suppose, to the neighborhood in some capacity, but primarily to the folks who live in the apartment. That's sort of, is that your understanding?
I mean, I don't think it's restricted. I mean, it's obviously convenient to them.
Okay. And these comps that you've used here, I see that they're all, well, about 1,200 square feet or less. Have you considered the larger spaces in our subject?
The large, aren't they like around the same size roughly?
No, they're a little bit larger. Two of them are larger. We can get to that in my evidence, but I presume that you haven't. And would you agree, though, that as based on the principle of economies of scale, as the leased area goes up, then typically the unit price would go down, the net rent per square foot? Is that your understanding of economies of scale?
If all else is exactly the same, that is my understanding.
Okay. Okay. And in terms of the cap rate that you've applied for the class code 60, is that modeled?
Yes,
And is there any evidence here to support that in your brief whatsoever?
just model.
Okay. And in terms of the non-recoverable, has the city provided anything to support their position on the non-recoverable expenses?
I do not have any literature in my brief.
Okay. Mr. Chair, I think those are my questions, and I thank you.
I thank you, Mr. Story. Swear on questions of the assessor.
None at this time, thank you.
I thank you. Mr. Selene, questions of the assessor?
Yes, just to reconfirm your cap is for the 20D, 60D. They're both model driven.
Yeah, yes.
Okay. Thank you. That's all my questions, Mr. Chair.
I thank you. Mr. Barocas, everything, just to, the cap rates are all model driven.
That is correct.
Okay. All right. Mr. Story, your presentation, sir.
Thank you, sir. Okay, here we are at 105 Sage Creek Boulevard. As I mentioned, I was there yesterday. I wanted to check my notes on the CRUs, the commercial units on the main floor. So ultimately, just to sum it up here, we're looking at a cap adjustment on the multifamily. And we're also looking for an adjustment to the commercial space, and I'll go through that for you very briefly. Now we've established where this property is. On page 3, you can see the main level. Those are the CRUs, the commercial rental units. At the reference date, there was one lease in place, and it was for the Empty Cup, which is well, I thought it was more of a coffee shop, but it's in fact more of a restaurant, quite frankly. So full menu with I believe it's licensed as well. So we were in there. So that was the rent that was known to us at the time. And since there's a small ice cream parlor that's 1,272 square feet, a health office at just a touch over 2,500 square feet, and a medical center. I believe the health center is a physio place. It's largely an open concept room, and then a medical center at 3,700 square feet. So we'll get to that very quickly. Now, Mr. Chair, I'd mentioned that there are indeed 7 buildings on site. If you look at my overhead shot on page 4. I should say 7 buildings for the complex, 3 buildings under appeal on this roll. So if you look at that little red teardrop, you can see the 3 buildings. The building facing Burning Glass is the one that has the CRUs in it. And now the property that I'd mentioned that had been applied the 5 cap, which I believe is Superior, has all of the amenities. It has the clubhouse, that's the smaller building on the right-hand side. Now this is a separate roll number, but it does function as a single economic unit. While we have this roll under appeal, we have to recognize that a preponderance of the 1 bedrooms are found in this roll. So it's 67.76. That's a very, very high degree of 1 bedroom and a very, very low degree of 2 bedrooms at 23.68 and of course 8.5%. Now that's not to say that the complex doesn't have a very good suite mix. It does indeed. But if we're looking at this rent roll in isolation, then we have to be cognizant of that. We have to be aware that that would be considered a value negative, to be fair. The property is wood frame. We have multiple buildings on site. It's typically been our contention, and I don't know that the city has argued with us in the past, but multiple buildings with multiple systems to maintain typically would speak to increased risk versus obviously building vertically and having everything in one tower, so to speak. So, and you can see that in the brokers' reports where they, when you look at a high rise of 6 stories or higher, typically, well, at least one of the brokers is showing a quarter point downward adjustment. So we would say that the wood frame, perhaps if the building has a second life, it does make it a little bit more difficult to convert, for example, to condominiums. Multiple buildings may also be a consideration, and we have to recognize that the major tenant amenities, and that's sort of the part of the panache of these newer complexes. They're on the associated property roll, but they're not on our roll, so we have to consider that. So with all those points taken into consideration, we're suggesting a capitalization rate on the multifamily of no less than 5.25%. That certainly makes sense when we consider 145 Sage Creek, the sister building. It certainly shouldn't be any lower than 5%. And based on what we've presented here today, we feel like 5.25% makes sense. You can see on page 9, Mr. Chair, I've included the market reports germane to the reference dates that we'll be talking about today. And you can see that typically cycle over cycle, we're looking at cap rate compression of 0 to 25 basis points. But all in, I think that 5.25 makes sense for this property. Mr. Barocas is quite right. We are about $2,000 higher on the NOI. So ultimately, this is a cap rate issue only on the multifamily. So we do respectfully submit that after visiting the property, speaking with the owner, and looking at a site-specific basis, that the value not exceed $30,324,547, which of course rounds to $30,325,000. That's on the multifamily. Now, in terms of the CRUs, I had mentioned to Mr. Barocas, we have 9,050 square feet. I believe he's used the same square footage, but that is over 4 different tenants. Now, at the time, the only occupied space with a lease in place was indeed the restaurant at $26. Now, $26 for a restaurant makes sense. It's not a national, and restaurant leases tend to be longer, and they tend to be a bit higher because you have to fit up the space for the equipment required for proper venting, grease traps, and that sort of thing. So based on what we know at the reference date for the restaurant, now we're calling this retail, we should also be cognizant of the April 1, 2021 reference date. So that's the height of COVID. So we should be conscious of that when we're looking at the cap rates for retail and office. and we'll get to that. But ultimately, we've looked to the market for higher quality space. I would say that, in the sake of brevity here on page 12, the last three rents that I've provided to you are probably my best ones. They're between $22 and $24, and they are medical. They're on Corydon and Lorimer. I think that's and they range from $700 to $4,700. So it's a pretty broad swath, but I think we've done a pretty good job of assuming that if we know that the restaurant is in at $26, that similar space, which was vacant at $1,200, we've applied a high rent, frankly, at $26. But that makes sense given what we know. And then the larger spaces, we've adjusted downward slightly as the leased area goes up. So, for example, the 2,544 square feet, we've put in an estimate of $24 per foot, and the 3,700 square feet, we've applied $23. So ultimately, we're not worlds apart here. The model suggested 25, but based on an actual analysis of the property, we've applied 24.21 based on the table that I've provided on page 12. In terms of vacancy and collection loss, we're not disputing the 6%, though that very well could be higher as we are in a lease-up period effectively. Shortfall rate is not in dispute either. You've all been provided with our non-recoverable study. You've all heard it many, many times. We have a full standalone study, but I suppose one thing I will point out with a new property is one of the major inputs that we would consider are leasing commissions. And if we are considering that at the time this property was being leased up, that owner would certainly bear those leasing commissions, those space marketing costs right off the hop. So this is in our opinion, this makes perfect sense to apply the full complement of the expense ratio. And I do point out again that we've provided our study. I'm happy to speak to it, but the city has not provided anything to support their position. In terms of our cap rates, again, we've provided you a full retail cap study. Now, ultimately, this property, I've mentioned the covenants. I don't think that it's ultimately comparable to the nationally, to the shopping center across the street. It's a little more niche. It certainly doesn't benefit from the large amount of parking, but we're not suggesting it's in a bad location or any such thing. But we are suggesting that on a site-specific basis, the cap rate ought not to exceed 6.75 for the retail. And again, we have to consider that, in terms of the say the office and restaurant or that type of operator at April 1, 2021, that was certainly a risky business to be in, as we all know. Anything in hospitality and office were certainly, I would say, hit the hardest. So with that being said, on page 22, we've provided our workup, and you can see our class code 20, the commercial valuation, based on what we've supported here, ought not to exceed $2,772,689, which then rounds to $2,773,000. Page 23 includes the combined value, I should say. So based on $30,325,000 on the multifamily and $2,773,000 on the commercial, we feel very comfortable at a value of $33,098,000. Again, I've provided you on page 25, Mr. Chair, of a blow up, so you can see it is. I think it's crucial that we understand that this is a complex. So we have our red highlighted space. Those are the three buildings that we're dealing with. And then the other appeal that's already been heard that we've mentioned here is 145, and that is the sister parcel, and it does indeed operate as a single economic unit. The folks who rent at 105 and the other two buildings can use the pool on the other roll, and they can certainly use the clubhouse. But if we were to separate this roll and put it into isolation, we have to account for the fact that it does not have those same amenities, and it has a different suite mix, to be certain. I'd mentioned the suite sizes. We'd have some back and forth, but you can see on starting on page 29, the smallest one bedrooms in this property are 484 square feet. That is a far cry from 1367 to be certain. And then the larger suites are, I believe, 1143. Yes, and that's those are the 3-bed, 2-bath. That's on page 35. The balance of my brief includes those same marketing photos as provided by the assessor. I do note once again that on page 42, that's the interior of the clubhouse and the exercise room. That is on the separate roll. So not to put too fine a point on that. But I think barring any questions, that is my submission. I thank you, Mr. Chair.
Mr.
Yes.
Chair? Sorry, Mr. Chair, we're having a hard time hearing you. You're breaking up again. Did you want to repeat what you just said?
Thank you, Mr. Story. Mr. Barocas, questions?
Just a couple.
Can you hear me?
Page 12.
No?
Yep, yeah, I can hear you. Yep, I can hear you. Just on page 12, just your least comparable information. You didn't use the rents at all from the adjacent, more commercial-centric property in this list?
No, I didn't. I think it's superior. And I think it would be distortive. I think we have to be careful not to use national covenants, for example. And again, I was there yesterday, and I can tell you and it's mostly the folks who are in our property are mostly, I would say, they're benefiting by walking traffic, let's say. I don't think it would be appropriate to use a national covenant or a national fast food chain like a Domino's or a fitness center or some such thing. I think it makes sense to use the rent that was known and to consider on a site-specific basis.
Okay. And just in terms of kind of tying the adjacent national covenants to the property on a cap rate basis, do you think that the subject property benefits from an exposure standpoint from the adjacent aforementioned larger, more retail-centric property?
I don't know if I would say that. I think that the location, I mean, they're benefiting from the same location. There's a lot of development there, to be certain. It's new. So if I just go back to your photos, those units that you're showing, like the Round 9 Fitness and Mary Brown's, they also have a door on the other side that faces a huge parking lot, and that's discount and grocery anchored. So I think that by principle of substitution, you would likely be commanding a premium for those that are benefiting from proximity to large national anchors and benefiting from a large amount of parking. So I think they're different enough that you'd have to make an adjustment. But I think that we have a good rent here at this restaurant at $26. So I feel very comfortable with what we've presented. Do I think that our folks benefit from being across the road, for example? I think the whole area is benefiting from the development there, but I do think that if you were to be in that main retail horseshoe, it would certainly you'd have better exposure than ours. But I don't think it's a huge. I suppose it would be subjective, but I think the rents would be higher in that nationally covenanted anchored strip.
Okay, those are my questions. Thank you.
I thank you. Ms. Warhon, questions of the applicant?
Just for like more for my information, you kept stressing about the 1 bedroom. There was 103 units of the 1 bedroom, and it was I don't know if you use the word deterrent, but out of curiosity, how many of those 103 units are rented?
Oh, I don't believe that there's a vacancy issue. Typically for these newer properties that have that have been marketed and leased up, I think there's not a vacancy issue, but the reason that I'm stressing the suite mix is, Mr. Bruin, is because obviously if we can agree that a 1-bedroom rents for less than a 2-bedroom, and a 2-bedroom rents for less than a 3-bedroom, but a 3-bedroom has less of a market, then typically a 2-bedroom in the suburbs would be maximally productive. They would be ideal. They command a higher rent. So and this complex overall does have a good suite mix, because we have to consider that it functions as one economic unit with 145. However, because we're looking at this one on its own merits, we have to consider that a 67% suite mix of 1-bedrooms is extremely high. And that's evidenced by the assessor's comparables too. So I don't think there's a vacancy issue at this stage, and we've certainly not adjusted upward, though we occasionally will to capture lease up. I know that typically vacancy at our reference date was about 7.4% for newer units. There was slower absorption, but we've applied a market rent here, or sorry, a market vacancy. But the reason that I'm speaking to the suite mix is that it does affect the durability and the potential for income growth to an owner. It is preferable to have 2 bedrooms in the suburbs at this stage rather than 1, and slightly larger suites are certainly more preferable.
But the owner did put in 103 1-bedroom suites for a reason.
In these 3 buildings, but in the other building, 145, which is, again, it's all one complex. They're just on 2 rolls. So that one has a much higher degree of 2-bedroom suites. So overall, when you take the 2 rolls together, there's no concern with the suite mix. The suite mix only becomes germane to our discussion on cap rate when we split those 2 assets out and put them on 2 separate roll numbers. So overall, there's not an issue, but and I'm certainly not suggesting the owner, didn't build a maximally productive unit, or asset, but because these are on 2 rolls, we have to consider what's before us today, and it just so happens that there are more of the, not bachelor, but these are more of the 1-bedrooms in this side of the complex.
Okay, thanks. That's all my questions for now.
Thank you.
I thank you, Mr. Celine.
All my questions have been answered, Mr. Chair. Thank you.
I thank you. Either party want summation at all? Mr. Barocas?
I mean, in my opinion, I think that the retail's in a really good location. That there's, it's across from the Tim Hortons, the Sobeys, the Subway, the gas station on the adjacent property. There's no doubt that they benefit from that location. I think that is reflected at the very least in less risk, because people who are renting the commercial retail on the commercial space in the subject property just know that it's going to be a lot of traffic going by. And I think our cap rate is solid at 4.7 for the apartment side, just based on my workup for 2390 McPhillips, using the actual rents in place at the time of the sale. That's my summation.
If I may, Mr. Chair.
I thank you.
Thank you, Mr. Chair. Just very quickly, we are not suggesting in any way, shape, or form that this is a bad location. We are suggesting that the city has not provided you with any evidence to support their cap rate. They've not supported their rental rates, and they've not supported the non-recoverables in any way, shape, or form. We've provided you with standalone studies that are very well researched, and I would ask that those be given weighted consideration as opposed to the model. And then finally, the cap rate on the apartment, if the assessor is relying solely on 2390 McPhillips, I think there's certainly enough question marks there that we ought not to rely primarily or solely on that sales. since we know it was purchased with the intention to raise the rents. And when we look to the brokers who typically deal with the higher, more institutional investment grade properties in our market, they are indeed suggesting no less than 5%. So I think given a site specific assessment of the property and a review of all the facts on hand, that 5.25% makes sense, and 4.7 is far too low and not supported by anything other than what we would call a miscalculation of the cap rate of the Lady Joyce on McPhillips. And I thank you.
I thank you. Mr. Barocas, Mr. Story, are you okay do you want to have a little break here, or do you want to continue for the, for maybe another, couple or whatever?
A 5-minute break would be great.
All right. All right.
Thank you.
Let's take a 5-minute break then, and you can clear your throat, make your coffee, etc. So, Madam Secretary, shut us down for like 5 minutes, and we'll reconvene at, I guess, 10:15. Okay. All right. Thank you. We'll call the hearing back to order, and the next property that we're going to deal with is 390 Academy Road. And Mr. Barocas, the floor is going to be yours, but there's a series of evaluations, and the first one that we're dealing with is the 218 evaluation for this 390 Academy Road. So, and I think there's a recommendation on there, but the floor is yours, Mr. Barocas, whenever you're ready.
Okay, thank you very much. I'll read up to the recs and then pause.
Sure.
Yeah, file number 23-428, roll number 1205005900039 Academy Road, 2022 roll year, currently April 1st, 2018 reference date. You can see the original model valuations right there, 5,754,000 for the 20 and the 2,613,000 for the 60. So it's two buildings. It's kind of an interesting property. We've got one newer building that was built in 1986. It's a smaller, originally built as commercial. And then we have what was Uptown Alleys beside it that was renovated into an apartment and including some commercial area as well. So we'll get into that more as we go along. We're just giving you kind of an overview to set the table as we get started here. 23 suites on the residential side. We don't have any parking. Recommendation, which is to reduce the 20T classification to 4,484,000 to better reflect market value. That's a 5.5 cap. And also removing an additional land adjustment. That was a holdover that should have been removed from the record when there was that additional land in the interim construction period. Now that the building has been renovated into an apartment, that should not have been included in the calculation. Hence,
Mr. Barocas, can I interrupt you 1 second? You're removing the additional land adjustment.
Yes.
So give us the figure that is. I think we know
that
it.
Is, yes, that is on page 3.
Okay.
And I've highlighted that in red there at 821,000.
All right. I'm sorry to interrupt you.
No problem at all. So that generates a 20G classification. From what I understand, is basically equivalent to what the applicant's asking for that line for this roll year. And then I've also amended the 60T classification to 2,622,000. There was a slight error in the unfinished area commercial deduction that we had. It's 2,258 unfinished shelf space, where the fit up at 120 per square foot ought to have been 279.60 on the reduction, not 279 from the office standpoint. So yeah, I know it's an increase. I didn't ask for it. I don't know if you're gonna grant that, but I'm just straightening the numbers out, if you know what I mean. So that results in, you can see on page 5, when you look at the office valuation and the corrected office valuation, yeah, corrected unfinished area adjustment, office recommendation to the office goes up a little bit, and then the existing retail doesn't change. So the rounded 60T goes up slightly with straightening the numbers out, but again, that's at your discretion because I did not, again, apply for an increase, no matter how small, but I'm just trying to vet any sort of size questions.
Mr. Barocas,
yeah.
Mr. Barocas, so can you give us the value for the record for the class code 60, the office?
Yes. Well, for the commercial, or for the office or the overall commercial?
Overall, total.
Okay, no problem. That's on page 1. That's just 2,622,000.
Yeah. Okay, that's fine.
I'll stop there.
All right. Mr. Story, are you in agreement?
No, I'm not, Mr. Chair. I should say, Mr. Chair, very quickly though, we've applied a 5.5 cap to the residential, and I believe Mr. Brokes had mentioned 4,484,000. Is that, Matt? Is that what you said?
4,485.
4,485. Okay. Well, Mr. Chair, we're at 4,483,000. So we're fine with that. We're very close. So that's fine. So I suppose this is now just a office and retail appeal, if we can agree to that 5.5 cap rate.
Okay.
4,485,000 on the 20.
Yeah. So we get this right. You are in agreement with the 4,485,000.
Yeah, that's
correct?
fine as per our original submission. Yep, that's fine.
Okay, so that's class code
20.
20. Okay. And you are not in agreement in regards to class code 60.
No, sir. We'd like to
Okay.
proceed with that.
Okay.
Okay.
I think Mr. Barocas, maybe you can continue that part of the 60 then.
Okay, no problem at all.
Okay. Yeah.
So just rolling through to page 3, you can see the parameters for the commercial, the office, and retail space. So we've got our model parameters here in terms of cap rate, expenses, gross potential rent, and then the unfinished adjustments. Again, for the office column, the first column, instead of 279,775, I have amended it to 279,60. There is also another amendment coming up in forthcoming properties, which goes the other way, but regardless, there's not much of a change in valuation there. So we've got our rents on page 4 that have been assigned to the properties, rather the retail and office space. So they're between $17 and $20. Pardon me. Their sizes for the office stuff anyway is in the 500 to 900 square foot range, and then you can see the square footages for the retail, 2,000, between 2,000 and 4,000. Then we've got page 6 is our residential comps. So page 7, this is our commercial comparables. So what I did is I really focused on basically properties on Academy. This is properties on Academy. So we've got, well, first of all, the first two rents are commercial rents that were in the property before it was renovated. So $20 and $19.50. And then we've got a little bit further down Academy. You can see how the rents range. They go 15 to 20, there's some in the 29 range, way up high, but most of them are kind of clustered around, give or take $20. And I mean, we're at $18, $19 on our commercial rents as assigned by the model. So I didn't make a change in that regard. And then again, our cap rates and expense ratio, pardon me, is model. So page 8, this is our chart you've seen before. Going to page 10, just kind of a bit of the scope of the work. But that's, I mean, this, it's got a, there are obviously several permits for an undertaking or renovation this large. Again, the second smaller building, which you can see on page 11, which is kind of with the red arrow on top of it, that was built in '86, was renovated as well. It's the older building, the former bowling alley that was also renovated, but it is much older. The commercial area we're talking about initially wasn't built. I think it was from the 30s, the old building was. So the declared construction value is $7 million. So obviously they had to spend a bunch on retrofitting the old building into mixed use. So some pictures of the outside on page 12, and you can see that they've kept the original outside. I believe it's got a heritage designation. That's probably why they didn't just knock the whole thing down and start again. But regardless, they're still able to get approved for a massive amount of renovation to the property. They kept the outside. And you can see pictures from the outside. And there's some pictures of the commercial space as well from our, I didn't inspect it, but members of our staff did. And then there's also some, pardon me, unfinished area as well. The source of the cost to fit up at $120 per square foot for this reference period deduction. Just a whole bunch of pictures here, giving you an idea. And I believe the applicant would have many highly similar photos as well. So you can see in the basement area, if you follow me to page 32, that renovations included system updates as well in terms of the mechanical aspect. So it was quite an extensive renovation, hence the permit value of $7 million, electrical, whatnot. So basically, the outside of the cost to fit up adjustment for the unfinished area, the parameters were all modeled. I believe the rents are supported by the rents that were there at the same location, the commercial rents before the renovation, and also it's adjacent comparators. That's my evidence. Thank you.
Thank you. Mr. Story, questions?
Just a few, sir. Thank you. Mr. Barocas, our reference date is April 1, 2018 for this file, is it not?
Yes.
Okay. And so this permit value that you've mentioned a number of times here is final date is 2021, so more than 3 years post-reference?
Yeah,
Okay, okay. All right. So, Mr. Chair, I'm just going to ask that that's not considered in the board's deliberations. Mr. Barocas, you're aware, of course, that this was the Uptown Theater, then became the Uptown Bowling Lane, and is now the Uptown Lofts. And I think you mentioned that it has a heritage designation. Are you aware that it's actually a grade 3 heritage designation? So it's the strictest of all designations.
I didn't consider the heritage designation in the overall valuation, so no, I'm not.
Okay, and is the valuation model derived?
Are you talking
Besides
about
the recommendations? Yeah, besides the recommendations that you've made in terms of the commercial side.
Yes, I didn't. Well, I mean, there was that unfinished adjustment, so I guess technically no. But the other parameters, yes.
The main parameters, let's say. Okay.
Yeah.
And
yeah.
okay, and you mentioned that you didn't consider the grade 3 heritage designation. Does the model have the capacity to consider some of the restrictions with a heritage designation?
I don't believe that that's something that is on a strictly modeling basis considered.
Okay, and we can speak to that in my presentation. Now, in terms of the actual year and effective year, that's based on what is that based on? Is that based on your visit to the site and then an adjustment, or how does that come to be?
Well, I mean, just to be clear, I didn't inspect this site. Other members of our staff did, but they would have taken into consideration like the relative level of work that was done. So I mean, the old building was 31, and then I mean, you can see from the pictures like they did a ton of work. They gutted it and then just put new mechanical in and totally changed the whole use.
Right, but it's based on, I suppose, what I'm getting at, Mr. Barocas, is if it is indeed a at the discretion of someone from the department, and that adjustment is made to the effective age, that will indeed affect the output of the model, then, will it not?
Yeah.
Okay, and you mentioned that they gutted it, and that's fine, but they did indeed retain the facade. So the building envelope is that same kind of Moorish theater type look from the 30s. Fair?
Yeah, I think it's pretty good looking.
Yeah, it's unique. And in terms of, well, I'll speak to heritage a little more as we go on, so I'll leave that if you hadn't considered it. But in terms of the, you've included a fit up allowance of $120 a foot, and we don't dispute that, but are you aware of the amount of vacancy in this property that persists to this day?
From a commercial standpoint?
Yes. Speaking strictly to commercials, I think we've dealt with our apartment side here, but from the retail and office side, can we agree that there's a great deal of vacancy in this property?
I mean, I guess that would be post-reference information that the board couldn't consider, right?
Well, okay.
If
not
that
sure.
is the case, again, it's not in my evidence, so I can't.
Well, but hold on. If you're providing a fit up allowance for a great deal of the space, then we can assume that somebody's not occupying unfit space, right? So it's not necessarily post-reference. We're talking about the physical, the physical condition at the reference date to be certain, correct?
That is correct, based on it not being fit up. I don't think anyone's renting the bare area.
Right. Okay. And if it is all indeed modeled, and we've gone through the apartment side, I think I'll save my comments, Mr. Chair, for my presentation. So, Mr. Barocas, I thank you. Those are my questions.
I thank you. Ms. Warhan, questions of the assessor?
None at this time, thank you.
I thank you. Mr. Celine?
No questions at this time, Mr. Chair.
Okay. And Mr. Barocas, for the code 60, we can't increase it, so it's probably going to be the 2,613,000.
Yeah,
Correct.
I understand that.
Okay. Mr. Story, your presentation?
But thank you, sir. And I will narrow my comments to our issues. We have 3 years to deal with here, so I'll try and be expedient. Effectively, we are.
You take your time, Mr. Story.
Okay.
There's a lot of work that goes involved. So
there was a lot of work to be
You
certain, and
take
this
your
one
time.
is. Thank you, sir. This one is a bit complicated, but I think we've mostly getting the apartment out of the way is for this file is helpful. So I guess what I'll say here, Mr. Chair, is I visited this property in it was either the first or the second week of September. So in addition to our desktop review of all the information on hand, I was also able to go through the property with the operations manager as well as the property manager. So I have a pretty good handle on what's going on here. And in terms of our class code 60 valuation, this is the crux of our dispute. The vacancy allowance of 5.5%, that's a market vacancy. That's too low. We have adjusted it to 15%. 15% makes sense at this stage, and you'll see as we go forward that has not ameliorated. And part of the issue is, Mr. Chair, when we have a property that's call it an adaptive reuse of a heritage property, there are some considerations, and there are certainly some limitations. Now, I don't want to suggest that we are anti-heritage in any way. I've been very, very pro-heritage in the city through all of my adult life, both professionally and personally. So that's not the case. But we do have to recognize that there is a cost associated with subtending heritage buildings as they benefit our communities, to be certain. But once a heritage designation is applied, it does amount to a caveat on title. And then any work that you do has to go through a separate permitting process. And just to sum that up, effectively, it costs more money and it takes more time. So, and there's not typically adequate compensation for the owners. So the cost of heritage is typically borne by the very few, even though it's enjoyed by the many. And we have to be cognizant of that. So we do consider that cap rates for heritage properties are slightly higher than those that are not. So that will be a comment that I'll continue to allude to. But in terms of the vacancy, I found it interesting that we are in a major thoroughfare. We have a high income capture. We're in a very good neighborhood here in River Heights. But because of the heritage designation, we have some issues around signage, for example. That makes the space a little harder to lease. You can't affect the front facade of that building. So if you drive by and have a look, it's very difficult to see the tenants who are even in the new building. So signage is a major concern from a leasing perspective. And secondly, because we've built this building, the units that are inward facing have what I'll call a major lack of fenestration. They don't have, some of them don't have windows. So as you can certainly imagine, leasing an office without a window is very difficult. So that has led to a higher than average vacancy. We've not used the actual vacancy, but we are suggesting that 15% makes sense. So that is our first point of contention, and we will use that on the office and the retail, and I think that's appropriate and very well supported. In terms of our non-recoverables, Mr. Chair, we've provided you with our study, and you've all heard it many times. And similar to the property we just looked at, when we do have a preponderance of vacant space, we have to consider that space marketing costs and leasing commissions make up a great deal of the non-recoverable expenses, and that's all outlined in our study. So in this case, we do continue to apply 7%, and that's the standard allowance of 2% is a structural reserve allowance, which, quite frankly, in a heritage building ought to be a bit higher, but we're sticking with 2% there. And 5% is the stabilized allowance for non-recoverable expenses that arise in competent management. In terms of the office valuation, the assessor is applying 6.7%. We've used 7%. It's slightly higher Again, we recognize the heritage issue, and the assessors quite rightly pointed out, we don't have parking associated with this specific role, which is not totally typical, but these are some of the peculiarities, we'll say, about these heritage buildings that are well, they almost this one doesn't quite predate cars, but it's getting pretty close. So there's definitely less of a need for parking in the early 1930s than there is now. So ultimately, on balance, when we apply the 5%, a 7% cap rate makes sense. We have also accepted the downward adjustment for the fit up. That's fine. Now, ultimately, for the retail valuation, many of my comments will be the same. The 15% allowance is well supported there as well. The main, we'll call it end cap unit. The city has some photos. That used to be a dance or a yoga studio. It is completely vacant. It would be the sort of the prime retail space. It's right on the end. It does have windows. It's large, and it is vacant, and that vacancy persists. So ultimately, 15% is well supported in that case as well. And we have not disputed the 7.9 cap rate the assessor has used. We think that's right on. So we're accepting that. So and then the downward adjustment similarly is not disputed either. So basically, this is a question of slight adjustment to the cap rate and the overall class code 60. Definitely an adjustment to the vacancy in order to capture the actual goings on at the property, and of course our non-recoverable expenses, which are well supported by our study. So if you follow me, please, here to page 14. This shows you the office and retail breakdown, and ultimately in our total line, you can see that the two streams by our analysis calculate to $1,992,091. So we are respectfully submitting that the value of the class code 60 for the at the April 1, 2018 reference date not exceed $1,992,000. This with the multifamily, this is a nice round number of $6,475,000. That's on page 15. Though I suppose if we're at $4,485,000, that number then becomes $6,477,000. And again, I did visit this property. I can show you the rent roll on page 19. You can see there's a great deal of vacant space. You can see the current marketing and listing info. That's all there for your perusal. The suites are nice. These are the staged marketing photos. But because that's not in dispute, I can mention that I did. Mr. Baroque has mentioned that they have updated the systems. Well, of course they would have to. This is a very old building, but you can see in my photos, and I don't know if the city has included these, but some of the basement area is not in great shape. I mean, they certainly have done a great deal of work to it, but I mean, ultimately the building envelope and some parts of the foundation are indeed from 1931, so we have to consider that. I've included some main floor vacant space. You can see on page 37 that that's one of those premises without an office. There's no drop ceiling at this point. It's just a raw sort of space. Anyways, I will leave those photos with you, and you can see again from starting at page 40. That's that main area that I mentioned that used to be a dance studio. You can see the mirror on the wall. Ultimately, we feel very comfortable with our submission here, Mr. Chair. And with that, I will end my presentation, and I welcome your questions.
I thank you. Mr. Brocus, questions of Mr. Story?
Yes, please. I mean, I know you mentioned the heritage designation, but just judging by the amount of work they've been allowed to do thus far, would you anticipate there would be that the purchaser would anticipate municipal resistance to further work? Like, is the heritage really an impediment?
Oh, absolutely. Yeah. So it's not a question of how much more will they be permitted to do. It's at this stage, you're quite right. They've built the property, it's functioning, but where these heritage designations come into play occasionally are with things like I mentioned with signage. Any sort of permit that is done is no longer goes through the standard channels at PP&D, but now has to go through the Heritage Resource Committee. It has to be approved by a different governing body, and typically the vendors who the owner is permitted to use are must be prescribed by that Heritage Resource Committee. So again, I'm not suggesting that work can't be done, but what I am suggesting is that it typically, almost from my experience anyway, it takes longer and it's more expensive, and there are simply more hoops and red tape to jump through. And further to that, Mr. Rokas, the property now has a caveat on. Well, it's had it since the 80s, I believe. That's when they were using the grades. But the property has a caveat on title, so that runs with the property, and the likelihood of that heritage designation being discharged is very, very low. So it's not to say that they won't be permitted to do any other work, but it is to say that there are going to be some issues that come up, such as the signage, which will affect the rentability of the commercial space, and frankly, the costs associated with doing basic permitted work are more costly and more time consuming than a property that does not have that designation. So that's sort of the short, the long short answer on heritage designation. It's obviously important to maintain these buildings, but we have to recognize that there is an added cost and red tape and bureaucracy involved in owning these buildings.
Okay, and just further to that on your page 2, I know you mentioned some signage.
Yeah.
I'm looking at the pictures. It looks like there's some signs on the side of the building and signs in front of the building. Is that the kind of the signage you're talking about?
No. So are you talking about the temporary signage for Colliers, the leasing?
Yeah, like I'm not sure what you mean by like signage restrictions. When I look at the picture here,
I have a perfect example for you. So if you look at the far left of the old building, right, and you see that little Juliet balcony right before you get to the new extension,
yeah,
and then look at that little how do I explain that? That sort of, it's kind of a brown colored, I don't know how to explain that shape, but you see what I'm talking about? It's there's the doors, and then there's underneath that Juliet balcony, there's sort of, it almost looks like an obelisk, that tall, thin strip.
Yeah.
Okay, that's the signage for the offices that's what they were permitted to do. So so not ideal, let's say. I mean, you might miss that walking past it. So never mind. The benefit of being on Academy is obviously there's high traffic, it's a high income capture, that's great, but that is the signage that they were permitted for that building on the left, and that is not ideal. So I'm glad you brought that up. I almost forgot, but yes, that's one of the issues.
You probably have to use your smartphone.
Sure.
Sorry, Mr. Applicant, what page was that? Which page?
Oh, Mr. Seelan, that's on page 2 of my brief.
Thanks so much.
Yeah, it's and if you look, the second set of doors, there's a little Juliet balcony, and then there's a small little, that the name of that shape escapes me actually, but it's sort of obelisk-ish. It's sort of brown, and you can, if you look very close, you can see that there's sort of gold lettering. That is the those are the tenants in that office building to the left. That's the signage that they were permitted to put up, and that's based on the fact that the heritage designation says that they are not to affect the facade of the building. So it's just one of those small things that people don't tend to think about when it comes to heritage, but it does clearly affect the if you're leasing space in that building, you would certainly want a greater degree of signage, let's say. So
thank you, Mr. Story.
Thank you, sir.
No further questions.
I thank you, Ms. Brokus. Ms. Warhan, questions? Mr. Story?
None, thank you.
Okay, I thank you. Mr. Sterling?
No questions, Mr. Chair. Thank you.
Okay. Either party wants summation, Mr. Brokus?
Oh, thank you.
No, I think we
Okay.
could save it to the end, Mr. Chair, once we're done with the other two
All
files
right,
on this property.
that's
Yep.
fine. Okay, let's move on to the same property, 390 Academy Road. This is the 2022 S. Mr. Barocas, the floor is yours, sir.
Thank you. Just let me pull everything
Yeah.
up here. All right. Pardon me. 23, file number 23-429, roll number 1205000 49000, 390 Academy Road, same property, different reference here. You can see the respective, pardon me, classification valuations on the first page. So I did make a recommendation again to remove the additional value adjustments. Again, that was the hangover on page 3. Again, that's in red of 881. I did not make a change to the capitalization rates. So the resulting 20T amended valuation is 5,246,000. And then I made a quick amendment to the 60T classification. Again, that is on page 5. So what I did was I mentioned that there was a miscalculation of the unfinished office area. This time it goes slightly in the direction of a reduction at 125 per square foot as per the more recent reference date. So it's not a big change, but just sharpening things up changes the overall rounded 60T to 3,041,000. I will pause right there.
So, Mr. Barocas, you're in total, is it 8,367,000?
In total, let me. 8,287,000. I believe 5% plus 3. 8,287,000. Yes.
We have so many figures in front of us here. So 8,287,000 and
Yes.
okay. And the apartment.
It's on the first page under the recommendation portion, page
Okay,
1.
okay. I have so many notes here. So can you just give me the figure? Is it 5,754,000?
It's so it's 5,246,000 on the first page.
Okay.
And that's the amended 20T just by removing the additional land adjustment and leaving the rest of the parameters the same. You can see the overall breakdown. If you go to page 3, that's basically what the rounded valuation is before the adjustment. So you can see the calculations on page 3 for the apartment side of the coin.
Mr. Story, are you in agreement?
No, sir, I'd like to proceed. Thank you.
All right.
Okay. One moment, please. Try to make this efficient, I'm gonna verify the notes I have in regards to the apartment stuff, or I read things off and take up time that doesn't need to be taken. Okay, thank you very much. Back to our brief. So it's the same building, just a different reference period, April 1st, 2021. So we don't, on page 2, we don't have, pretty reference date. Information in regards to the renovated property, but they've always been compliant in the past when it was functioning as a different operation. No reason so. At least through land titles we have on record here. So income valuation again is on page 3. Parameters are modeled, just glancing ahead, unless anything's changed on the apartment side of the coin. The net operating income were within $3,000 of each other. So it is a cap rate difference, just to kind of narrow our conversation unless something's changed. So with a 4.9 cap for this reference period, it generates the rounded rec of 5,246,000, again, not including that figure in the red. So then we have our commercial, and it is, again, it's all modeled. You can see our cap rates, our expenses, and vacancy, so on and so forth, right there. So it's the same property. They use the same methodology to amend the unfinished area deduction with a slight correction. So you can see that on pages 4 and 5, and that's reflected in my overall 60T recommendation on page 1. Page 6, these are our rent comparables. We're pretty similar in terms of effective gross income, so I think we got to the same spot pretty much the same way. So I'm not gonna really sit on those. And here are the comparable leases. Again, I looked at stuff on Academy, and we have the leases 1 and 2, what was going on in the building before it was renovated, essentially. $20, $19.50, and we are sitting at, if you look at page 4, $19, $20. So that's where they were renting the spaces for back in 12 and 13. So that combined with the other rates supplied to the department from the other commercial spaces on Academy, I didn't make any consideration of changing the rent. On the commercial side of the coin, again, cap rate chart on page 8 and 9, you've seen before. Page 11, again, this is just shows kind of like the declared construction value at $7 million. It's not a surprise given all of the work that was done, change the use of the building. And then again, the photograph on page 12. And then the pictures you have all seen and talked about last go around. So just another reference period, different cap rate on the apartment side. That's my evidence. Thank you.
I thank you. Mr. Story, questions of the assessor?
I have some questions, Mr. Chair, and I'll ask that some of those questions pertain to all 3 that I asked in the previous file carry forward. But in terms of new questions, Mr. Barocas, I'm looking here on page 6, and we talked about this on Sage Creek. We can agree that on page 6 under the subject, the city isn't suggesting that these are 2,000 square foot units, are you?
No, that's again, gross floor area. It's inclusive of all areas, which would be the same for all of these units. And yes, just to clarify, it is a bit misleading, but I don't remove it because it's included in our brief.
Yeah, okay, and you're saying it's the same for these other ones, but this is a res-am, right? and the rest are
And
res
yeah,
app. So,
yeah.
okay. Okay, just so we're all on the same page about that. Now, in terms of, and you're right, the NOI we're using is not worlds apart here on the apartments, but one thing I noticed, and I did mention it in the previous file, is that if, according to your evidence and our evidence and what the brokers are telling us, they're suggesting that the cap rate compression for apartments is typically between 0 and 25 basis points. But it appears what you've submitted here would indicate a compression of 60 basis points. Do you have anything to support that in your evidence?
Well, again, I don't know how the brokers calculate their evidence. I don't really put the weight on it. But weight on my own analysis that I personally did on page 8. Again, one sale doesn't make a market. Typically, when people build new buildings, they don't turn around and sell them right away. So 2390 McPhillips is the best example that Altus and the city of Winnipeg is using in their cap rate studies.
Okay.
That calculates to 4.7. So I'm not putting any weight on what the brokers have to say or their compression or how they did it, because I don't know how they did it. And the ones that I've seen how they did it, I don't agree how they did it.
But a big part of your cap rate evidence is indeed the broker's tables in both instances, correct?
I didn't put any weight on that. I put weight on our own analysis.
Okay. And 2390, I mean, I think you just said people don't typically build and then sell, but that one was built in 2015 and then sold within 5 years, correct?
Again, it's atypical.
Okay, right, and I agree. So I don't think we should be using it as a comp for this property, but so are you suggesting then that you're only comparable for the apartment stream for this heritage adaptive reuse is then the one on McPhillips? Is that what you're saying?
I'm not saying, I'm saying like just based on the photographs and the condition of the property. That is, though it's obviously not perfect or apples to apples, the comparable I would put more of my consideration on, the lion's share of it.
Okay. And the Lady Joyce on McPhillips has parking, as underground and surface parking. Ours has none on its own roll, right? Okay.
Yeah, I mean, there's parts where the Lady Joyce is superior, and there's aspects where I believe this property is superior. Again, it's not apples to apples, but unfortunately, we don't have anything.
Yeah, and sorry, did you say that the cap rate here was modeled, or was that overwritten by you for the apartment?
No, this is modeled.
It's modeled. Oh, okay.
Yeah. Whereas the last one was overridden because we have an agreement at a higher level of board, and I'm trying to make things as expedient as possible. Just for the context of the board, we don't have an agreement for 2023. It's a whole new reference period. So please do not take the recommendation made for 2022 for the residential side into consideration for this file and the next file, because it's inappropriate.
Okay.
And it would probably lead us to stop making recommendations at the board of revision for 2022.
Okay, so in terms of now same question for the vacancy rate for the class code 60, that's all, I'm guessing all those parameters are modeled, is that correct?
Yep.
Okay, and so I guess my question is the previous cap rate for the office was 7.9%. So how did it go to 6.05? That doesn't seem to make sense, does it?
I mean, again, it was done by the model based on the information that was supplied to the city from the expense manuals and market data. So I'm not a modeler, I'm not privy to that. So I can't speak on that.
Okay, but just as a general, somebody's observing the real estate market in Winnipeg, can we agree that the reference date of April 1, 2021, that's sort of the heart of the COVID pandemic. So it doesn't seem odd that retail and office, those were sectors that were hit pretty hard by COVID, were they not? So we wouldn't expect I guess my follow-up is, we wouldn't expect the cap rate to ameliorate from April 1, 18 to April 1, 21, would we?
You know, I've never heard anyone say that word before, but I think it means go down. I
Ameliorate would
don't
mean
know.
get better. Yeah, it doesn't make sense that the cap rate would be.
I get what you're saying, yeah.
Yeah, right.
Those
Especially
sectors were hit hard. They were hit hard, and
right.
I can follow your line of questioning for sure.
Okay. Okay. And I think, well, I think that's fine. We've talked about Lady Joyce and the brokers table. So I guess my question is about the compression. And Mr. Chair, I'm just going to ask that the balance of the questions that I asked for the previous follow through to this file. And Mr. Brooks, I thank you.
Thank you. Ms. Warhan?
No questions.
Okay. I thank you. Mr. Celine?
No questions, Mr. Chair. Thank you.
Okay. Thank you. Mr. Story?
Yes, thank you, sir. Okay. So ultimately, we have the same building with a different reference date. Now, again, I was there. I'd mentioned it was September 7th, 2023. The photos are in the back of my brief. You can certainly see them. The assessor and I were talking about the suite sizes. I also have a breakdown of the suites in my appendix. I didn't mention it previously. Many of the same issues persist. We are recognizing that there is 0 to 25 basis point compression in the market. That 5.5 cap is precisely what we presented, not based on anything else other than our view of the property. We recognize that it is a bit tricky in that it's not a completely new building. It's hard to call it a 1995 when we have so much of the building that is indeed heritage. It seems a bit odd to have a property that has a heritage building but then has an effective age of 1995. So we have to consider all points taken together. So we do feel ultimately that 5.5 as a cap rate makes sense. I agree with Mr. Brooks. We don't necessarily have an apples to apples comparison in terms of the sales in the market. We've provided you with our cap rate study, and we've also summarized the broker's reports on page 9 of my brief. And I have noted a number of times here that when we look at low rise A, low rise B, we're typically seeing compression between 18 and 21 in quarter one of each period. We're seeing cap rate compression of 0 to 25 basis points. So ultimately, we've elected to continue on with that 5.5 cap. That will be for this reference year and for the next, as it is based on the same reference date. In terms of the office income, we're not disputing the 1994. That seems to be in range. Once again, 15% on the vacancy. That is, I think, quite fair. We've applied it previously. We've not seen substantial amelioration in that regard. So 15% is well supported. Once again, in the previous cycle, we provided you with our non-recoverable expense study. So just as background, Mr. Chair, based on the fact that these are two reference dates, the two reports that you have been submitted are different, and with every cycle, we conduct an exercise to determine whether or not that non-recoverable expense ought to be considered. Now, you'll recall that for the 20 years or so leading up to the previous cycle, that allowance had been applied by the city. It continues to be applied by municipalities outside of Winnipeg and the province. So ultimately, it's on the assessor to prove to us that it is not indeed appropriate. And again, we've not seen anything in our evidence here today, though we have provided you with the updated non-recoverable expense study based on the 23-24 cycle, whereas with the previous file, it was based on a reference date of April 1, 2018. Now, we've also provided standalone capitalization rate studies for both retail and office. There's a typo in my brief on page 16. For retail, we are using 15%, not 6%. And that's based on our based on a site-specific analysis of the property. Our retail cap study has been summarized, as has the office. But ultimately, this is a question once again of well, the cap rates that we're using are precisely in line with the cap rates that we agreed to in the previous cycle. We were much closer in the previous, and it does beg the question, why office and retail cap rates in the assessor's model would be indicating less risk in the suburban office and retail sector when we know that this is a reference date of April 1, 2021, and we know what the landscape was like in commercial real estate for office and retail specifically. So though I think we could have gone a touch higher on our cap rates, I feel very, very comfortable with 7 and 7.9. This is directly in line with what we had submitted for the previous cycle. So we're holding them steady with a blended cap rate of 7.49%. Again, the vacancy is considered and the non-recoverables are supported by our study. So all that to say, Mr. Chair, that on page 21, if you look at our total office and retail valuation, we come to 2,139,625, which rounds to 2,140,000. And again, the fit up adjustments at 120 a foot are not in dispute. That seems about right. So ultimately, on page 22, we come to a total value of 6,882,000. And that's based on 4,742,000 for the multifamily, 910 for the office, 1,230,000 for retail. And again, that value calculates to 6,882,000. The balance of my brief once again shows you the different suite types and the marketing materials. You can see the commercial rent roll indicates the vacancy that we've been mentioning a number of times. And once again, you can see, the ash is the large suite at 1,193, all the way down to the elm. The Niagara suite is 583 square feet. The building does have a huge preponderance of 2-bedroom suites. I think it's about 90%. So ultimately, I feel very comfortable with our value. And with that, I'm open to your questions. Thank you.
Thank you, Mr. Story. Mr. Barocas, questions of Mr. Story?
You mentioned that the broker report said there was a compression in cap rate. Yet you had the same cap rate for the residential side. Why didn't you reduce it?
Yeah, so what the brokers are showing us, Mr. Barocas, is cap rate compression between 0 and 25%. So for example, Colliers is showing us 0% and 0%. So low rise properties, presumably good properties and good locations, the change is 0%. CBRE is showing us low rise A 0.25 to 0.25, low rise B 0.25 and 0%. So I suppose the question is, should the compression that's being applied to this property be 0 or 25 basis points? We don't see any indication that it ought to be 60 basis points. So I suppose it is at our discretion based on what we know of the property. We know that there's no parking. We know that it is adaptive reuse, and we know that it's also it's not completely separable from its commercial component. So it's a res am. So ultimately, I feel good at 5.5% with all those points taken into consideration. But it's a good question. The cap rate should be between 5.25 and 5.5, but given the very, very specific nature of this property and some of these issues, I feel very comfortable at a 0 basis point compression over the previous cycle.
All right, those are my questions. Thank you.
Thank you. Ms. Warhan?
None,
questions?
Mr. Chair. None, thank you.
Thank you. Thank you. Mr. Celine?
No questions at this time, Mr. Chair.
Okay. I just have one really question. Mr. Story, I guess in the previous evaluation where we went back to 2018,
Mhm.
we have a code 60
Mhm.
for yourself, and you've determined that it's 2,613,000, correct?
Oh, let me just pull up my
Okay.
previous
Yeah.
file. Yeah, so 852 and 1,140,000. So
Yeah, like, but in total, two million
yeah,
613. Okay,
yeah.
so when we move on to a V-Day of 2021 for class code 60, you're down to 1,992.
Wait, hold on one second, Mr. Chair. So in terms of for 2022, we're at 1,992,000.
Yeah,
That's right. Yeah,
so
and so for
you're
20,
dropping. So why are
yeah,
you dropping here?
well, because the fit up allowance is higher from one year to the other. So it's actually, if you look at our what the assessor and I are both suggesting, our rents are not in dispute. It's a question of the vacancy. And yes, the shortfall is the same, and it would be dropping because I think because of that downward adjustment for fit up. And typically, Mr. Chair, um, it does make sense that the costs to fit up a space over time are higher. You can imagine as you do work to your house or whatever, the cost overall on a per unit basis is higher now than it would have been, say, 3 years ago. I think that's what's giving
But
rise
Mr.
to a lower
but Mr.
commercial value.
but Mr. But Mr. Story, you're dropping $600,000.
Well, hold on. Let me pull this up here. So in 2022, I just want to make sure we're all on the same
Yeah,
page.
like
Yep.
I had to look at it a few times.
Okay, but in 2022, we're at 1,992,000.
Yeah,
And in 2023, sorry, we're at two
okay,
million
but
one
we're not
thirty
there
nine.
yet. Yeah, but we're not there yet, okay? So
But hold on, but that's
I'm going
yeah.
back to the evaluation V-Day of 218, where you
Yep.
had 2,613,000.
No. That's not
No,
correct, sir. No, on
that's not
page
correct.
14, no, on my brief, page 14, this is for the 2022 supplementary, which speaks to 2018 V-Day. Our value is 1,992,091, and it is higher, though not only marginally higher, based on what I've suggested, at 2,139,625. So
All
that's
right.
page 14 of the first brief and page 21 of the second brief. So it's from 1,992,000 to 2,140,000.
Okay.
Yeah.
Okay.
You scared me.
Summation, either party.
I think we'll just save it to the end of the next one. That'll be it.
Okay. Let's go on to 390 Academy Road, because I think Mr. Story will both parties will have a summary. So let's go on to 390 Academy Road, and this is for 2023 and a V-Day of April the 1st, 2021. And there's a recommendation, Mr. Baracus. So let's go there.
Yeah, okay, so I made a recommendation on this one, file number 23-430, file number, same property, same roll number. I made a recommendation, just again, removing the additional land adjustment on this one. That can be found on page 3. And then that was the only recommendation that was made for this one. There isn't a commercial fit up adjustment on this one, so that's why there wasn't that second component of the recommendation that we saw from the last file, even though it is the same reference period, it's a different physical reference date. I'll just pause there.
So your recommendation is at the 25,246,000, correct?
5,246,000 for
Yeah.
class code 20T.
20,
And then
and the 60, and
no,
the 60.
no recommendation on the 60.
Okay. And offhand, can you give me the total? Is that 3,041,000?
Let me just add this up. So 8,786,000.
Matthew, what is your total for the two class codes? Is it, I have 8,287,000.
So I've got the 5246.
Yeah.
And then you add the 3,540,000, 8,786,000 for
Okay.
2024.
Yeah. Okay. Okay. Mr. Story, are you in agreement?
No, sir. And just to be clear, that land adjustment was just there in error. So that should never have been there. So no, we would like to proceed. Thank you.
All right.
Okay, so yeah, it's the same discussion as last time. We just don't have the commercial unfinished adjustment on this. Files 2024. I mean, we're not there yet. We don't know if it's been fit up or not. I mean, the property, I believe at the time that it was put on, it was assumed that it would be fit up by this time period. I don't think the applicant has an adjustment on their evidence, unless I missed it. So I don't really think that's in dispute. All else being the same, it's the same commercial comps. It's the same residential recommendation less the, or it's based on getting rid of the unfinished additional line adjustment, which the applicant is right in saying should never have been there in the first place. So without going on and on, that's my evidence. Thank you.
I thank you. Mr. Story, questions?
No, I think that this is effectively the same set of questions, Mr. Chair, that I had for the previous, and we're not disputing the removal of the fit up allowance. So in this instance, I think I'm just going to simply ask that my questions from the previous file carry forward if the board is okay with that. Thank you.
I thank you, Mr. Story. Mr. Mohan, questions of the assessor?
None, thank you.
Thank you. Mr. Salim?
No questions, Mr. Chair. Thank you.
I thank you. Mr. Story, your presentation, please.
Yes, thank you, sir. Well, we've gone over our methodology here for this property a number of times. Again, we are recommending, Mr. Chair, that the vacancy, the modeled vacancy that's been applied by the presumably by the model is too low. We continue to apply 15%. Again, our non-recoverable expense study has been provided to you, and we do highlight once again that based on the fact that there is a great deal of vacancy and the fact that the space is being actively marketed, that should be given some extra consideration today. In terms of our cap rates, we've mentioned again, Mr. Chair, that in the previous cycle our blended cap rate was 7.49. That was roughly in line with what the city is suggesting. And we see no reason to believe that there should be cap rate compression on the commercial side based on the reference date and what we know was happening at April 1 of 2021. And just, Mr. Chair, because you asked an interesting question, I just want to make sure we're very clear. When we go back to the 22, the value that we're supporting is 1,992,000. For 23, it's 2,139,625. And in this case, it's 2,607,611. And what gives rise to that $500,000, say, increase is the fact that we have agreed to remove that, call it the $487,000 fit up allowance. The space is largely fit up, though it is slightly better than shell space, we'll say. And I think on balance, based on what we've submitted here, our value makes a lot of sense. So I do respectfully submit that our value for this year not exceed on the commercial side 2,607,611. Of course, our multifamily value is rounded to 4,742,000. So ultimately, our value on a whole comes to 7,350,000 even. So for this file, we do respectfully submit the value ought not to exceed 7,350,000. And I will just ask that my other comments for the past three or the past two files carry forward. And with that, I'm open to your questions, and I thank you.
I thank you, sir. Mr. Barocas, questions?
No questions, thank you.
I thank you.
Yeah.
Ms. Warhan?
No questions, Mr. Chair. Thank you.
Okay, Mr. Salim?
I know you mentioned with respect to the last two files that you had a vacancy of 15%. Can you
Yes, sir.
maybe elaborate a little bit more here on how you came up with 15%?
Absolutely. At the reference date of 13,613 square feet, there was over 8,000 vacant square feet. So well over half, far in excess of 15%. And as I mentioned, just as a quick refresher, I did note that there are some issues with leasing this property that we learned from our discussion with the property manager. We know that there are some office areas that do not have windows. We know that the main floor area that used to be the dance or yoga studio is currently vacant. So there is a great deal of vacancy here. Now, we're not suggesting that we ought to apply 50% or some such thing, but in order to adequately capture some of these issues, we have applied 15%, and I think that's more than supported based on our site-specific analysis of this property. So thank you for the question. I'm glad you asked, because I wanted to clear up that figure that we had over 8,000 square feet vacant. So thank you.
All right. Let's go to the, I'm sorry?
Thank you. That's all my questions, Mr. Chair.
Okay. I thank you. Let's go to the 390 Academy Road again, and we'll do the 2020 floor. Mr. Barocas, the floor is yours.
I think
we just did.
We just
sorry,
did
Mr. Chair. I think we just did 24. We should be. I think we finished all of them now.
Oh, sorry. I had to refer to my notes. Okay.
No problem.
Hang on. Yes. Okay. Sorry. All right. Mr. Story, thank you for your presentations and results very soon. So you're free to go, and thank you. And Mr. Barocas, we're going to shut this down because we have some other properties that we have to deal with you. So Mr. Story, you may go. Mr. Barocas will put you in the holding, and we will shut it down, and the panel will deliberate in regards to banning. So Nicole, whenever you're ready, you can shut us down.
I'm just going to put Mr. Barocas in the waiting room, and I will be right back.
All right, thank you. And Mr. Baracus,
Oh,
we'll
yeah, just
okay.
hold on a second here.
Get him back in there.
Okay,
All right, we'll call the hearing back to order. Mr. Barocas, we have some cleanups to do here. And the first one is 748 Banning Street. They are no-show, so you can read a few things into the rule, briefly describe, and then I think we'll deal with the recommendation on this property and I think on the other property. So the floor is yours, but we'll do them individually, okay?
Yeah, makes sense. I'll go quick. File number 23-111, roll number 130-225-79000, 748 Banning, roll year 2024, assessed value 342. I made a reduction to reduce the property to 142 to better reflect market value. Page 6 shows the calculations. I've inspected this property. It's a tear down. Anyone buying this property will look at land value only, less the neglected improvements. So look at demolition permits, the relevant time period, and reduce that from the land calculation to come up with my recommendation. That's my evidence. Thank you.
And the recommendation figure is $142,000.
Yes, it is.
Okay. Was this conveyed at all to the owner at all, or any
yeah,
contact there?
Oh yeah,
Okay.
well, we've done lots of talking on this one.
Okay. So any emails exchanged or telephone calls?
Well, this particular applicant doesn't have email, so I have gone the extra mile in terms of in-person and telephone conversations with them.
Okay. And he is in agreement with that, or they are?
Yes, yes, they are.
Okay. Ms. Warhan, any questions in regards to the recommendation?
None, thank you.
Okay, I thank you. Mr. Salim?
No questions. Thanks for hearing. You went the extra effort
Okay.
with communication here.
excuse
No
me.
problem.
So, Mr. Brokus, you feel as if I think you deducted $40,000 for the demolition. Is that
Yes.
seem to be right?
Well, yeah, I mean, if you look
All right.
at my page, I actually pulled demo permits because I didn't know how much it would cost on page 7. I didn't want to guess, went through our system. So
I see.
I looked into it.
Did you get to the property at all? No.
Oh yeah, I've
Oh,
been
you
to
did.
both these properties.
Okay.
Anybody
So-
potentially purchasing this property isn't going to
They're
try and repair it
tear
or
down.
rely on the
Okay.
records available.
Wow. Anybody living there?
Nope, not for a long time.
Okay.
You can see the
Okay.
pictures at the end of the brief.
Yes.
There's moisture, there's a lot of issues. No one is going to spend money remediating it when they can knock it down and start fresh. This is a individual situation specific to the deferred maintenance, so to speak, of this individual property based on the site-specific analysis.
Yeah. All right, let's go to the next property, which is 757 Banning, and you can read it into the rule and probably just discuss that same reasoning behind there.
Yeah,
The floor
100%. Thank you. File number 23-112, 757 Banning. File number 130-224-56000. I reduced it to 219 to better reflect market value, and again, it was based on removing the derelict, neglected apartment. Page 7 are the calculations. That's my rec. The applicant is aware of that, and they agree to it. Hence, they're not here right now.
All right. And because of this value of 219, it was accepted, and the lot is bigger than the previous one.
That's why, yeah.
All right. Ms. Warren, questions?
None, thank you.
I thank you. Mr. Celine?
But just to confirm, both these properties were for the 2024 year.
Yeah, this is for the 2024 year, physical 2024. No one's lived there, and nothing's changed. There's a lot of problems with this property. So, and no one would try and assume that. They would scrape it and start again at a cost to scrape it, of course.
Understood. Thank you. That's all my questions, Mr. Chair.
Okay, I thank you. Matthew, I thank you kindly for your presentations, and we have heard all the items scheduled, and this hearing is now adjourned. So thank you, Matthew.
Thank you.
Have a good day. Excellent
You too.
job.
Yeah. Thanks, everybody. Have a good one.
You
Thank
too.
Yeah.
Bye-bye.
Okay. Nicole, you can shut us down, and we can get to our deliberation.